everyone. Today I'll be presenting my literature review of a paper titled Stock Prices Forecasting and Optimization Strategies Based on Support Vector Machines. This paper explores how machine learning, specifically SVM, can be applied to predict stock market trends. I'll walk you through the key findings and methodology in the next 8 minutes. The author of this paper aimed to address limitations in traditional stock market analysis. Technical and fundamental analysis often requires extensive expertise and produce subjective results. This research focuses on developing a more scientific approach using machine learning to predict whether the SCI 300 index will move up or down the following day. The central question is whether SVM can effectively forecast these market movements with reasonable accuracies. Before diving into the methodology, let's briefly recall what is SVM are. SVM is a powerful machine learning algorithm used mainly for classification. It works by transforming data that can be easily separated in its original dimension into a higher dimensional space where separation becomes possible. The algorithm creates an optimal decision boundary or hyperplane that maximizes the distance between the two classes. This approach is particularly effective for handling complex nonlinear relationships in data, which makes it potentially suitable for stock market prediction. For this study, the author used data from the SCI 300 index, which represent 300 large and liquid stocks from China two-man exchanges. The dataset spans from January 2005 to March 2024, comprising 4,657 trading days after cleaning. Let's now introduce the types of variables present in the dataset, which includes both raw market data and technical indicators. First of all, we have raw market variables, which are all numericals. This includes the opening price, maximum price, minimum price, closing price, and traded volume. These values represent direct measurements from the stock market. Next, we include the derived technical indicator, specifically the Relative Strength Index (RSI). RSI is a momentum oscillator used by traders to measure the speed and change of price movement. It is also numerical in nature. Finally, our target variable is used for prediction. It's categorical variable that indicates the stock trend's direction for the next day, classified as 1 for upward trend or -1 for downward trend. Together, these variables give us both the raw financial context and the technical layer to support forecasting stock movement. The data pre-processing stage was crucial in this paper. First, the researcher cleaned the data by removing missing data and abnormal values. Then they normalized the variables using z-score standardization to put everything on comparable scale. A particularly interesting aspect was their use of the so-called Wavelet denoising with hard thresholding processing to filter out market noise while preserving important trend signals. They also only claimed to apply the denoising technique to the closing price, and the technical details will be skipped in this presentation. The data was split chronologically with 80% for training and 20% for testing, which respect the time series nature of stock markets. They also engineer features like the RSI indicators in the previous slide and to capture momentum patterns. So in general, the feature engineering include the derived RSI from the closing prices after the denoising, and also some calculated additional technical indicators but these are not explicitly listed in the paper. The methodology mainly focused on implementing SVM with various kernel functions, including linear, polynomial Gaussian, Laplacian, and sigmoid kernels. For parameter optimization, the researchers employed grid search to find the best combination of the penalty parameter C and the kernel parameter gamma. After testing multiple combinations, they determined that C set to 10 and gamma set to 0.001 yielded the best results. The model performance was evaluated using the standard classification metrics, which will be presented next. Let's see the result. Let's look at the result before optimization. The model accuracy achieved 61% accuracy on predicting next day movement. Breaking this down further, we see the model had higher precision for upward movement at 75%, meaning when it predicted an upward trend, it was correct 75% of the time. However, its precision for the downward trend was only 0.43. Similarly, Rico's values show the models identify 56% of the actual downward movement and 64% upward movement. So these initial results suggested that the model had a bias toward predicting upward trends, which is a common issue in imbalanced datasets. After parameter optimization, the model's accuracy improved significantly, 60 to 67%. Interestingly, the precision pattern reversed. Now the model's precision for downward trends increased dramatically to 74%, while the upward trends decreases to like 62% precision. So this is quite interesting. But also we can see that the F1 score is more balanced. Also indicates that a more robust model that handles both upward and downward prediction more effectively. The graph compares the model's prediction against actual price movement. As you can see, the model generally captured the overall trend direction quite well, particularly during periods of steady movement. However, there are notable limitations. The model struggled with extreme market movement, like the peak in 2007. Also, it struggles in rapid trend reversal, which are common during volatile market periods. This suggests that while SVM is effective for general trend prediction, additional technique might be needed to handle exceptional market conditions. So my own analysis is that the clear strength of this paper is to improve the improvement in prediction accuracy through careful parameter optimization. The Wavelet denoising techniques is also particularly effective for filtering out market noise. From practical standpoint, a 67% accuracy could potentially translate to a profitable trading strategies. However, there are the limitations. The study doesn't compare SVM with other machine learning approaches like XGBoost or transformer-based networks. The feature set is relatively limited, focusing mainly on price and volumes data plus RSI. Also, the paper also explores next day predictions, whereas multiple time horizons would provide more comprehensive insights. So based on the analysis, I would suggest several improvements for this paper. First, conducting a more comparative analysis with other ML methods would establish whether SVM is truly optimal for these applications. Second, expanding the feature set to include more macroeconomic indicators, or if you can do sentiment analysis from news or social media in the same time. and also some market regimes identification could enhance the prediction accuracy. Testing the model across multiple time horizons, meaning that the granularity can be set from days to months, would provide a more comprehensive evaluation. Additionally, measuring performance using financial metrics like risk-adjusted returns or shopping ratio, rather than just classification accuracy, would better align with investment objectives. Finally, exploring ensemble methods that combine SVM with other algorithms might yield even better results. That's it.